Good day folks, Jim here from Orchard Forex. It is Saturday the 27th of February. Well, it was a pretty wild week to end the month with rising yields in the bond markets driving much of the volatility elsewhere through the currency, commodity and stock markets. In the FX markets, after reaching some of our targets, particularly in the Aussie and the sterling, we've seen a good bounce in the US dollar, which has had a flow-on effect through to the other markets with commodities coming under pressure. And the stock markets actually ended the month pretty much flat, although the NzdUsd was down by 3% through February. For now, much of the action appears set to remain in the bond and FX markets. So without further ado, we'll go and have a look at the charts and see what they've got to say. Actually, before that, we'll just take a quick look at the heat map. And as you can see, bond yields are having a major effect. Dollar yen, the yen's going to remain under pressure, I think, as yields continue to push on higher. So I'd be looking to trade dollar yen from the long side. Dollar Swiss also looks pretty healthy. The euro, having made a false break to the top side, is now reversed and looks as though that could head low. The Aussie looks very heavy. The Kiwi slightly less so. In the stock markets, I think we're probably in for further downside there. Gold looks particularly heavy still, having broken some important support last week. And oil is that looks as though it's turned lower for now, having made a new one-year high, and that could have further downside ahead. In the FX crosses, we were short euro sterling last week, and that actually did reach our target on the downside before a pretty strong bounce. So we'll go and have a look at that. Elsewhere, Aussie yen actually looks as though it's going to feel the heat, particularly there. While Euro Aussie looks set to head higher. Elsewhere, it all looks a little bit mixed, and I'd probably think there's better things to trade. So we'll go and have a look at the charts anyway and see what they've got to say. Okay, we'll start off by just taking a very quick look at the bond market here, and yields do seem set to head higher to me. We reached a peak last week of 1.56. Didn't stay there very long, but as you can see, the weekly indicators suggest we are likely to head out. And if we can make a sustained move sort of above this 1.46, 1.5% level, then I think yields are going to head towards the next FIBO level here, possibly upwards of 1.8. Now, if that's the case, we are likely to see further strength in the US dollar. And so without further ado, we'll move along to the dollar index. And here we have a weekly chart of the dollar index. And once again, as you can see, the indicators seem to me to be, well, they're quite oversold and they seem to be heading higher. So I think we are in for further dollar strength. So the 91.60 is this previous high here in early February. That's going to be the first port of call. We're quite a way away from that yet, but we've been trading this sideways range between sort of 90 and 91.5, I guess. For much of the year really, but it does seem to me if we can take out this resistance at just above 91, so 91.10.20 area, we can head back towards the 91.60 and even possibly onto this FIBO level up here at 92.5. That's some way off at this stage, but I do suspect that's the direction we're heading in. So we'll go and have a look and see what the euro's got to say. Okay, so here we have a 4-hour chart of the euro, and having broken above this previous resistance, made a false break above it, took out a few stops, and it's now coming back to test the downside and sitting on some support here where this rising trend line comes in. But the 4-hourly indicators do appear about to head towards the downside. The dailies are pretty neutral though. I suspect there's better currencies to be trading than the euro right now. But we are going to see some support at this 120.5 and the 100-day moving average at 120.10. If we go back under 120, then I think we can possibly accelerate down, potentially back towards 118. But for the time being, as I say, I think we've got this FIBO support here, 119.50, 45.50. But I would be looking to sell rallies for the time being, looking for a break of this support just around here. And maybe we will see an acceleration lower over the period of time. There are better currencies to trade. We'll go and have a quick look at dollar yen. Okay, here we have dollar yen. It's been choppy, but it is pushing higher, and the 4-hour charts becoming slightly overbought and possibly running out of some steam, as shown by the RSIs here. So another dip wouldn't really surprise. But the dailies do appear to be picking up steam for the top side when we have broken this resistance. So if we came back into this sort of 106, we're 106.5 at the moment. If we came back down towards 106, possibly a bit 105.80 or so, I'd be looking to buy, looking to take out the top of last week, which is at 106.68, and possibly heading on towards this 107.20 area. That's my theory for the time being. And I think rising bond yields will really help push dollar yen along to the top side. So dips might be fairly narrow, and I wouldn't be looking for too much on the downside as long as the bond market stays, well, as long as yields stay as well bid as they are. And yes, look for 107 and 107, and beyond there, I think we can possibly head back to above here toward 108.15.20, which will be strong resistance if and when we see it. Sterling. Now, sterling pretty much reached our upside target last week, as I showed you. It got to 142.30, and then since then we've seen a pretty sharp reversal down to 139. It does look to me as though we can head lower still. So we've got this support here, the FIBO support to 138.70, and if that's taken out, then I think we can possibly move back down to this area of consolidation above 136. The 4-hour charts do suggest further downside. The dailies equally appear to be turning lower, and so I'd be looking to sell rallies. If we get anywhere near 140 now, I think is probably toppish. As I say, I'm looking for a move back towards the 136, 137. If we go, last week I showed you the Ichimoku chart, and as you can see, we more or less reached the peak up here, 142, well, 142.50 I think was what we were actually looking for. It got to 142.30 before the sharp reversal. We're now in March, and that top comes in at 140.50, 140.60, something like that. So, as I say, I'll be looking to sell into strength now because I think we're going to see a higher dollar, and you can put your stop loss really above 140.5. Although this is a monthly chart, so it's more of a guide than anything. But as I say, I am looking for a move back down in towards the middle of the cloud. With the base of the cloud is now a long way away. It's 131, but I think that is the direction of it. So selling towards 140 with a stop loss above 140.60. That's the plan for the coming next few days. Dollar Swiss is looking interesting. We've moved up here to the 23.6% FIBO of the whole drop, and that's providing immediate resistance right here, above which we've got the 200-day moving average at 91.40. If we break above there, then I think we can possibly head back towards this sort of 92, 90, 93 figure area. Dollar Swiss has kind of been leading some of this move, so it's worth keeping an eye on. The 4-hour indicators, sorry, I beg your pardon, the daily indicators are pointing higher, and the weeklies likewise, they appear to be picking up steam too. So I think we possibly can push on towards higher levels, and so therefore I'd be looking to buy dips. The Aussie, well, that reached our target of 80 cents on Thursday. And then we saw a very sharp reversal into the end of the week to sit down at just above 77 cents. The daily indicators now look as though they're pointing towards further downside. The weeklies not telling us an awful lot, but possibly a little bit toppish as we reach the end of, or the intermediate end of this bull run that we've seen for the last 6 months. And for now, I'd be looking to sell into rallies. Now, as far as strength goes, we could see it move back up to these short-term FIBO levels. This being at 77.60. Basically 78 cents, and the 200-hour moving average, which is at 78.50. The hourlies are now pretty oversold, so a bit of a bounce early on Monday would not surprise, but I would be looking to sell into strength for the time being, as I think, as I said, I think we're going to see further US dollar strength. As far as downside targets go, well, if and when we break this sort of 77 cent area, we could see it back down here. That's sort of 75, where's this, 75.60, so that's still some way off. There'll be interim support around this level here, sort of 76.5, and again at sort of 75, 80, 90, something like somewhere around there. So, but I think that's possibly the direction of it. If we do see a bounce up into this area somewhere, looking to sell into it for the next leg lower. Same really applies to the Kiwi. I won't dwell on the Kiwi for too long. Once again, we can see the Kiwi reached this sort of 74.5 level and rejected that quite firmly, finishing the week on its lows. This is a weekly chart, so 72.30. And the indicators may be providing us with a bit of a top, so I do think we're probably going to see further downside here as well. Coming back to nearer home, this is just an hourly chart. The hourlies are oversold, so a bounce towards this sort of 73 area where the 200-hour moving average is. 73, where's that? 73.15. I'll be looking to sell somewhere in that area, I think, probably with a stop loss above the 100-hour moving average early in the week. But the 4 hourlies are pointing lower. The dailies equally look as though they might have put in a top. But we're going to see some decent support down here. Whereas this sort of 71.60, a break of that could see an acceleration to the downside back towards 70 cents. But in the meantime, look to sell into any mild strength on Monday, Tuesday, with a view of breaking this trend support here. Now moving along to the commodities. Actually, before the commodities, I'll just take a quick look at a couple of the crosses that we pointed out last week. Euro sterling in particular, that hit our target down here, 85.70. It actually got down to sort of 85.35, which if you look at the weekly charts, it actually beautifully came down and touched this 38.2% level of the whole move up. And it's seen a good bounce back to, well, it got back to 87, the figure, but it closed the week at 86.60. The weekly indicators still point to further downside, so I still like this cross to head lower, and if and when we can break this sort of 85.25 level, possibly we can head back down to here to these previous lows, so 82, 80, 83, 82, 80, something like that. But that's a long way off at this stage. Coming back to nearer home, the dailies actually do suggest to me that we may just chop around this week, but it does seem to me as though we could head a little bit higher, back above 87. If we go back to the 4-hour charts, this top here, 87.30 last week. So that'll be some resistance, and if we take that out, then I guess we can move back towards this high here, about 87.80, where I'll be looking to sell into it again, probably with a stop loss somewhere above this 88.60 level, which acted as previous support in the longer term charts, which we can see here. It was these lows here, and I would be looking to sell into a rally, but have a stop loss. If we break back above here, then I think we can probably head higher, but I don't think that's likely to happen. Here we have Aussie yen. Now, although I think we're going to see a stronger dollar yen, yen weakness, I think Aussie yen is actually going to suffer on the downside, because it does, the charts do look a little bit heavy. This is a daily chart. And having touched our target, really, well, we got above our target of 84, got up to 84.90. It's now back down at 82 figure, and I suspect it can possibly come back down to test these previous highs here, and possibly even levels below 80. So once again, I'd be looking to sell into strength. As far as the 4-hour charts are concerned, this sort of level here is going to be resistance around 82.90. So I'll be looking to sell around 82.90, 83 the figure, with a stop loss probably above, so 83.70. Okay, so moving along to the commodities now. Here we have a 4-hour chart of oil, West Texas Intermediate, and the 4-hour charts do look heavy. Having said that, the trend is still to the top side, and if we go and have a look at the daily charts, the indicators might be coming a little bit overbought, and certainly the RSIs seem to be running out of steam. So I do think we can see further downside. But as the world economy opens up after the pandemic, I think the market seems to be speculating on increased demand for oil, and eventually we're probably going to take out this top here around sort of 63.80. And 65 was the really this high here, way back here. And also here, so that's 65, 66. I think those are targets for the longer term, but in the meantime, I think we're probably going to see a little bit more downside. But I'd probably be looking to buy it for a more strategic trade if we get back to sort of 50 or anywhere below 60. Really, I think with a stop loss below this sort of 58.5 level is what I'd be looking to do right now. If it got below 50, or if it got below 57.5, then I think I'm probably wrong, and it probably does have more downside to it. But generally, I think traders are going to be looking for the dips, and will be a buyer, because I do think eventually we're going to look at these previous highs way back from here. Gold had another tough session on Friday, and will look increasingly heavy, I think, if we are going to see further dollar strength. Now, it broke down below this important support at 1765, and headed immediately to the FIBO level down here around 1720. And the indicators don't look very pretty. And I honestly think if we're probably likely to see levels below 1700 sometime in the coming week. With 60, this low here, 1667, that's going to provide some support. And then further south, sort of 1620. That might be a step too far. But if we are going to see a stronger dollar, gold should remain under pressure. So I'll be looking to sell into rallies with a stop loss now, probably placed above 1765, maybe 1785 to give us a bit of leeway, though that might be too deep a stop loss for some traders. Just quickly looking forward to the stock markets now. This is the S&P 500 daily chart. We're coming to sit on quite important trend support here. And if we go through this, then I do think we're probably heading back towards the 100-day moving average. I think I pointed this out last week, so 36 3/4, 36.75, and possibly below that, all the way down to sort of 35.40. I think I'd rather be short the stock market for the time being. The dailies look a little bit heavy. The weeklies, as I've pointed out before, are overbought and look very toppish. The RSIs in particular seem to be running out of steam. So I'll be looking to sell any rally for the time being. There's plenty of cash sitting on the sidelines, so I don't think we're going to see a massive sell-off. But I do think there is room to head lower. It should be a fairly orderly move, I think. But below 3,800, it wouldn't really surprise me in the next couple of weeks to see it down at this sort of 36.50 level. At which point you probably start looking to buy it again. As I think eventually we probably are going to take out this 39.5, 39.50 level, but that probably won't be until the Biden administration gets to sign off on its rescue package. And in the meantime, a bit of a correction wouldn't really hurt, just to take some of the froth out of the market from this rally that we've seen over the course of the last 12 months. If I'm right on the S&P, the Aussie market will get dragged lower as well, although that's not it's not showing the same overbought conditions as the US market, because we've really traded sideways really now for several months, I guess, starting from here, which basically November. So basically November till now. But there is potential for downside. The 100-day moving average is at 65.25, and this channel that we were trading in previously, that's down around 64.75.80. So it wouldn't really surprise me to see us move back down there. If we take the base of this out, then I guess we can move back down to sort of 6,300, but that's still a long way off at this stage. And in the longer term, I actually do look to buy the dip as the economy comes out of the post-pandemic situation, and eventually I think we'll probably take out this 68.60, and we're going at some stage I think we'll probably head back towards these highs at sort of 71.40.50 level. Okay, so that's about it as far as the various products go. We'll have a quick look at the calendar. Okay, for the coming week, early in the week, the manufacturing PMIs are going to be the main event on Monday. There's not an awful lot else aside from the German inflation numbers. There's going to be a fair few Fed speakers, or central bank speakers in general. I guess we got Williams and Brainard from the Fed speaking on Monday, as well as Guindos and Lagarde from the ECB. They're all speaking on Monday. If we head towards Tuesday, the initial main event will be the RBA interest rate decision. No change to policies are likely, but we'll get an update on how the RBA do view the forward outlook as the economy comes out of the pandemic situation. We've got EU inflation data on Tuesday, as well as more ECB speakers and also Fed speakers. Beyond that, we then look towards Wednesday, when the services PMIs will be released. We've also got the domestic Q4 Australian GDP numbers to be announced. The ADP employment numbers will be released on Wednesday, and yet more ECB and Fed speakers. Thursday sees the Aussie trade balance and retail sales, US jobless claims, and Fed Chairman Jay Powell will be speaking. Then finally Friday winds up with the main event being the non-farm payrolls, which it looks as though we're expecting 148,000 jobs to have been created, with unemployment actually ticking up 0.1% to back to 6.4%. So we'll have to wait and see on that, but that's going to be the main event to tie up the coming week. So without further ado, we'll leave it there for now, and enjoy your week's trading. Hope you make a few good ones, and we'll come back with another video next week. Cheers.